Hey everyone, good day. Jacob Chaparro here with Zenith Investment Management alongside my colleague Pablo Marul. This is your February market update. We want to spend some time to talk to you about current market environments, which are volatile. We've seen a correction now take place. So we want to talk about some risks out there. We want to talk about currently if prices of stocks are high, if they're low, if they're neutral, and then just finish off by giving you an expectation as what we can maybe see here as the rest of the quarter progresses and of course the year. So Pablo, welcome to this month's update. How's it going?
Hi, Jacob, and hi, all our listeners. Well, basically, we have been talking about a correction for a long time. It has happened, actually. We are in the middle of the correction, basically. We don't know yet if it's only 12% like it's happened or it's going to be more than 12%. So far the market, the Standard & Poor's 500 fall 12% from the high to the low, the Dow Jones around 10%, Nasdaq from the peak that was in November 18, it was 19%, and the Russell around 23 from the peak again in November. We'll check if that's something normal or is the first time that happened.
For the year, the major indices are all down. You have the Dow Industrial Average here. You have the Standard & Poor's 500, the Nasdaq 100 ranges between -7. As Pablo mentioned, the tech stocks have suffered the most, around -14 for the year so far. Obviously, just a month, but something that we want to understand if, of course, this is the moment that we see a rebound or maybe there's more pain. Pablo here, do you want to take the lead on something that we want to show our viewers or clients in terms of understanding corrections? And it's something that we referenced, I think, last year, maybe around the summertime.
We have done the research in average 11 months, and the last one was in March 2020. So it was kind of overdue a correction in the market. So, and it happened this month. Again, who knows if could be more than 12 or more. This year, we already say in the previous month that it was going to be a volatile year. Maybe we have two corrections, who knows, but no. But the story is like what happened behind. So what is the rationale, why this happened? And again, the explanation is the Fed, because want to fight the inflation that everyone knows and they feel too, they are planning to increase the short-term interest rate more than that were expected, and that's kind of create the expectation of the 10-year rate, which is the rate that many people use to evaluate the companies, that this rate is starting to go up. And again, this rate go up and the valuation of the companies come down. So that's kind of the one of the rationale behind.
And there's always various amount of risks, whether it's, you mentioned inflation. Last month we mentioned supply chain. Employment was an issue that seems to be tracking pretty well. But if we had to pinpoint to one thing, if we had to, it would really be the Fed, because it really is two things. Definitely the Fed interest rate hike that's expected. There's even some economists out there saying that there could be as much as 6 rate hikes. That could be extremely unfavorable for the markets, maybe good for inflation, but the stock market historically doesn't like interest rates rising at a very, very short time span.
The acceleration, this kind of very quick increase on rates, which is good for our client that they are savers and they have deposit, is good because now you will receive more money in your deposit. But at the same time, if the 10-year rate, also you will see the increase on your mortgage. If you want to refinance or you want to buy a property, you will see the mortgage rate higher than in the past.
It's not all bad, like Pablo said, right? There's some good. Interest rates go up, we get more from our money markets and our savings, but then things are more expensive. The other thing too, to go back to the major catalyst here, who's really holding the lever is the Fed. It's twofolded. One being they have the lever to pull in hike rates and impact everything we discussed. The other thing too that's expected in summer, I believe, is their policy of stopping printing of money. So this is something that we've had, obviously, with COVID. The stimulus injecting money into our economy has helped us prosper through. That also is something that the markets typically don't like. You think about the supply of liquidity of money that's been provided by the Federal Reserve, and all of a sudden that's going to stop. Naturally, it's going to cause some type of short-term panic, potentially some type of short-term concern. That's something we're keeping an eye on. And to go back to the corrections, we were overdue for one. We're here right now. We don't know, obviously, until who knows 12 months from now if this was right now the bottom. And that's what we're working on right now. One thing that we said in January is the first half of this year, throwing the midterm election year dynamic, typically is pretty volatile. Not that we still don't see a fruitful year. Our expectations, the markets for the year be right around 8-10%. But right now, obviously, that's not looking too good. But it's only February at this point in time. There's still a lot of time here for the markets to respond. We'll definitely be keeping a close eye on what the Federal Reserve's actions are.
They control the short-term rates, but they don't control the long-term rates. So that's something that it will depend of expectations, supply and demand. For our viewers, they have to, if they keep long-term money, is something that is long-term, so you don't need it right now. And if you have some extra cash, take advantage of these prices, because in 2-3 years it will be more expensive. So,
and talking about expensive, one of the things that we have taken a step back and just try to understand, our stock's pricey. There's always going to be these different variants as to why the market sells off, but fundamentally, it's always a good starting point to understand, okay, is the stock market, is the valuation or the price, is it expensive? Is it fair? Or is it cheap? Tell us about the next graph here, Pablo, that we'll see here in terms of where we're at. And then historically, what is deemed a normal price to earnings ratio, which maybe we can talk about that high level.
But basically, we are finishing the 2021. We are kind of forward price to earning, which is a measure evaluate the Standard & Poor's 500 or any companies or indices around 21, which is high relative to for instance, in February before the pandemic, we were in 19, and then if you remember in 2007 before the financial crisis, we were in 15. So some people might say that the market is very expensive, but also earnings growth has been very robust and consistent too. It's very hard to say, but definitely, yeah, we are in the limit of a very pricey market.
The only thing I'll add to that is this metric a lot of institutions use. Obviously, we look at, which is called price to earnings, is how a company is quantified in terms of it showing potentially if it is expensive, if it's fair, or if it's inexpensive in terms of its value. And obviously, we want to always try and find something inexpensive, right? So that we can reap the benefits of the write-up and vice versa. We want to stay away from stocks that are already expensive. That gives us more risks to the downside. So the takeaway here should be that as you look at this graph one more time, the current price to earnings ratio as of the end of December 31st for the S&P 500 was 25. Historically, what is deemed to be a fair value for the S&P 500 is around 16. So we go from 16, we ended up at 25. That should tell us that, yeah, the short answer is stocks are expensive. Now, that doesn't mean that we can't continue to go up. This is something we'll reference back again, because we will show this chart again come April. And assuming where we stand with this present correction, whether this is indeed the bottom or maybe we have more pain to go, that number is going to look different. And I want to leave you guys with that, because as we always talk about, these corrections present opportunity. Something's always making money. Our job is to make sure, and we've done a really good job, credit to our team, to Pablo, to our investment committee, of identifying the investments in December that we currently hold that weren't expensive, that haven't suffered as much. So we'll reference that back. Just know that Yeah, right now too, fundamentally, the market is expensive relative to history. But with this recent sell-off, that will recalibrate and it might probably provide some opportunity here for the rest of the year.
Jacob, just just to do a summary for the last part of our market update. So, which is your outlook expectation for the next months or a couple of weeks?
Good question. I don't think our outlook has really changed a whole lot. I referenced earlier that if we stand here December 31st of this year, markets are likely to be prospering, not at the same levels as we had in previous years, but I think it's not out of the realm to expect probably an overall rate of return in the S&P 500 somewhere around 8 to 10%. I do believe that, and collectively, I should say, we Zenith believe that the majority of those gains are probably going to be in the second half. I would just communicate to those watching, especially our clients, that the norm should be to expect some volatility. We are not sold that this right now is the bottom, at least for the year. There's more scenarios that we potentially do go down more, but it's not all doom and gloom. The reality is unemployment's really low. GDP has slowed down a little bit, but all the other metrics that we won't bore you with from an economic standpoint, for the most part, look pretty good. A correction is healthy in a lot of sense for us to continue to have long-term success. Not the most fun to be a part of, not the most fun to see your accounts with a lesser balance from month to month, but know that there is some good out of this, and especially find some comfort that these are the things that we're doing. And like I mentioned, credit to our team to be able to forecast this and change our allocation and identifying good investments that weren't really expensive in December, so that the pain that we're going through, we really didn't capture all that downside. We actually favored quite well. We'll leave you with that. Of course, please reach out to us, to your advisor, reach out to me, of course. We're happy to set up an individual call with you and with Pablo too. If it's of interest to talk with Pablo individually or collectively, he's also part of the team and willing to assist in any way, shape, or form. So we wish you guys a very warm rest of February. I know on the East Coast, there's been some storms here, but we appreciate you guys watching. We appreciate you guys being a part of Zenith. We will catch up with you next month.
Thank you. Take care.